Hello and welcome to the Specialist Trading presentation of the one indicator you should never use for trading, Part 1. This is the Specialist Trading Weekly Stock, E-mini, and Forex lesson. Hello everyone and welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. And we know that a lot of traders like to use a lot of different outside sources and things to help them in their decision-making process on which to trade. But today I'm going to show you the one indicator that you should never use if you are trading, regardless if you're trading stocks, E-mini, or the Forex. Now, before we begin today's presentation, I ask that you please take a moment to view our disclaimer. I'm going to show you some performance results based on this topic, but please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, E-mini, and Forex lesson. All right, I'd like to start off this week's presentation by once again going over my experiences when I first began to trade on the floor of the stock exchange. As I've said many times in these webinars and in my seminars, excuse me, that I had a very difficult time trading in the very beginning. In fact, I traded probably the way 99.9% of all traders trade. I was trying to pick tops and bottoms, and I had far too many things on my trading plate. In other words, I was looking at far too many outside sources to help me make my decisions. Too many indicators, looking at too many newsletters, following too much news. Just everything was extremely complicated. And it's no wonder that I couldn't really get my performance running. In other words, I couldn't really see that my hard work was paying off because I had nothing to show for it. After my first year of trading, I basically was just breaking even in my trading style. So I thought, what can I do to get my trading going to the next level? Now, I had a group of mentors that finally sat me down and said, Steve, your trading is far too complicated. There are too many things that you're viewing, too many outside sources that you're relying upon that are actually getting in the way of your success. So I asked them, I said, well, what should I do? And they said, well, what you have to do is strip away what they labeled as useless noise, things that get in the way of your trading. So they stated very simply, they said, Steve, the one indicator you should never use for trading is simply the news. And I couldn't believe it because I thought, well, I have to know about the news. I'm trading stocks. I need to know about earnings reports. I need to know about what's going on in the economy. I need to know about economic news. And they said, basically, Steve, the news is getting in your way. If you have to let go of one thing, it should be the news. And I couldn't understand why. And the way they explained it to me is they said, Steve, all news is subject to discretion. In other words, it's all subjective. One person can read a news item and say, well, that's very bullish for the stock or for the market or for whatever you're trading. Another person can read the exact same news item and say, no, that's very bearish. You should be selling. That's bad news for the company or for the market as a whole. So they explained to me, and I finally had a little light go off that yes, it is subjective. Sometimes it works, but sometimes it doesn't. Sometimes I can discern exactly what the news is telling me. Other times I couldn't. I would think something was so bullish and I would buy and it would go straight down and vice versa. So what they stated is they said, Steve, if you're trading, you need things that are more cut and dry, more black and white. Things that can really tell you with high certainty that there's most likely going to be an uptrend after something has been indicated, as opposed to trying to decipher what it means. So they said the one thing, if you're going to let go of one thing, and the first thing, it should be the news if you're trading. Now they stated that if you want to be consistent in your trading, you have to keep things as simple as possible. And the news, even I know a lot of people wouldn't agree with this, but the news is actually not simple at all. It's very complicated because there's a million and one ways to discern it, to come up with what the ultimate thing it's trying to say. So they said keep your trading as simple as possible, and that's when you'll get on that road to consistency. So simplicity equals consistency. Keeping your trading plan as simple as possible rather than complicating it. So let's show you a few examples, and the current examples of just exactly what my mentors taught me and what I try to teach all the people and all of our members and students at Specialist Trading. Here's a news announcement that came to us in August of 2012. This was once again talking about Apple. This is in the Los Angeles Times, and the headline read, Apple becomes the biggest company in U.S. history as its stock reaches $623 billion. Now on August 20th, roughly 8 months ago, the article said, Apple has become the most valuable company in American history. On Monday, its surging stock propelled the company's value to $623 billion, beating the record for market capitalization set by Microsoft Corp in the heady days of the internet boom. Apple stock has hit new highs recently because of optimism around what is believed to be the impending launch of the iPhone 5 and possibly a smaller, cheaper iPad. So they have two products coming out. Very good news. Someone will look here and say it's the biggest company in U.S. history. This in no way could be discerned as something negative. In other words, boy, if you're looking at Apple and if you're long already, you want to stay long. And if you're thinking about buying, now is the time to get in because this is great news. In fact, here's a chart going back to August 2012. As we see here circled in green, this is when the news announcement was made. And it kind of stayed firm for the next month or so, going up even higher, roughly about to 40 points or so. But then look what happened. In the following 3 months, the stock dropped 25% in value in just 3 months alone. So had you listened to that news and relied on that outside source, what my mentors labeled as useless noise, you would have really been left holding the bag. And this was just going into November of last year. Actually, it got worse. But let's say you had held on, you were trading, or you continued to buy every time it looked like Apple was going to hit some type of low, you continued to buy because you figured that news can't be bad. It's got to be great news. Well, let's see what happened 8 months later. Let's fast forward to 8 months. This was just a few weeks ago. In April of this year, the new headline coming out in CNBC was Apple drops below $400 for the first time since 2011. Remember when the news came out, it was flirting with $700. Now it's in 8 months later, just a short time period, has dropped below $400. Okay, now the article reads, Apple accelerated losses, tumbling to its lowest level in over a year as investors continue to dump shares of the tech company amid worries over second quarter iPad mini shipments. Now remember, just 8 months ago, there was all this exuberance about the shipments of this iPad mini. Now things are the exact opposite in just a short time frame. All right. Now the once darling tech giant of Wall Street shed nearly 6% Wednesday, breaking below $400 a share for the first time since December 2011, following a report from DigiTimes that iPad mini shipments could fall 20 to 30% quarter over quarter to 10 to 12 million in the June quarter due to lacking demand in the market. So what they had thought was going to be impressive demand, which was going to be extreme demand for these products, really was lacking demand. So the news coming out in August of 2012 wasn't that good after all. What you would have come to the conclusion was that when you first heard it, that would have been great. Now, 8 months later, it's terrible. Now, if we look at the chart 8 months later, we see that Apple continued to fall, even lower than that last chart I showed you. And starting the new year, as you see here from 2013 up until just a few weeks ago, circled in red here, Apple was flirting with the price below 400. Now, had you read that article and you had held on for the last months of April, you would have finally said, you know what, I'm going to throw in the towel. It's below 400. The last two products didn't do very well. It's being told a lot in the news now how the company is really failing. So I think I'm going to just sell. So right where this red circular eclipse is right here, as you see with the chart, that's where the news came out, and that's probably where most people finally threw in the towel and got rid of all their stock. Now let's fast forward to what's happened in the last 2 weeks. In the last 2 weeks, Apple has gone up 60 points. I know it's not a lot compared to the large picture, but once that terrible news came out, you would have thought, well, now's the time to exit. Now's the time to even think about going short Apple. We've broken some strong support. Now's the time to exit or to go short. But look what happens. The stock goes straight up. As we've seen here in the last 2 weeks coming into this today, Friday, Apple has gone straight up. So you see how difficult it is to try and figure out what's going on if you rely solely on news or if you put too much importance on the news. So let's look at an overall chart. As we see here in the top left-hand corner, circled in green, that's when the good news came out. That's when, if you were standing by conventional wisdom, this is when you should have bought. And look what happened. Apple went straight down. Now, if we look at the far right portion of the screen, we see circled in red, this is where the bad news has been coming out. The worst news ever. We in the last year, we've gone below $400 a share, and look what happens. It's gone straight up since that bad news. So we're not saying that the news never works. What we're saying is that it's difficult to discern, it's difficult to decipher. So why get involved with an indicator that sometimes works and sometimes doesn't? An indicator that is basically 50-50. It's pretty much a guess. it would be better to be involved with indicators or things in your trading plan that are more cut and dry, that have a high probability for success, as opposed to something that's very discretionary, that is very subjective, where two people can come up with two entirely different ways to interpret. All right, so let's review. Who should use the news? Now, when we say you should never use the news in your trading, remember, we're talking about a specific type of trader. Now, there are two types of traders involved in all the markets. You're either an investor holding something for the long term. This could be anywhere from 5 to 20 to 30 years. Or you're a trader holding something anywhere from 5 minutes to maybe just a couple of weeks. So who should use the news as an indicator? Well, investors, yes. Investors should use the news. In other words, if you're holding something for the long run in your IRA account or in something that you want for your long-term savings, then by all means look at the news, because you're not going to worry what happens over the next 8 months to a year. You're more concerned of what happens over the next 10 years or 20 years. So by all means, the news should be taken into consideration. But the other side of the fence are traders. Now, if you're trading, should you be looking and using the news in your trading plan? No, definitely not, because you're not concerned with what goes on in the long term. You're concerned with what happens in the next week to maybe month. And with news, remember, it's all subjective. It can work or it cannot work. So we're not interested in using some type of indicator that has a 50-50 chance of working for you. We want things that are, put the odds in our favor that will give us a greater degree of success. Remember, my mentors taught me that in order to get that consistency in my trading, I have to keep things simple. The news, once again, is not simple. It's subjective. There's too many things to decipher. So we want to drop it from our trading plan and keep things as simple as possible. So the road to success is paved in simplicity. Now, next week, in wrapping up this week's stock, E-mini, and Forex lesson, I will share with you in part 2 of this series a simple, easier way to decipher when you should be buying or selling. An extremely simple, easy way, another indicator to add to your trading plan. So, in conclusion here, this is the one indicator you should never use, part 1, which is basically the news. If you are an investor, feel free to use the news because you're going to be holding on to it for a long time. If you are a trader, you should never use the news in any of your trading. It'll just complicate and probably take you out of the game too soon if you rely on news for your trading decisions. In conclusion, we always ask all of our members and students to learn our strategies and then to paper trade. This is how you will get onto this road of consistency in your trading. That's what we're aiming for as members of Specialist Trading. We're not looking for home runs, even though that may happen from time to time. Our real true edge here is consistency, and that's what we try to instill in all of our members at Specialist Trading. In closing, I ask that you take one last look at our disclaimer. I show you some performance results when you use the news and when you don't use the news. But please remember that we can in no way guarantee that any of these results will be repeated in the future. Thank you so much for viewing this webinar. We wish you the best of luck trading, and we shall see you next week with another weekly stock, E-mini, and Forex lesson.